So, good afternoon, everyone. Good evening, wherever you are. It's a great pleasure to be here. I really appreciate the invitation from Professor Daniel Schanfelde, and I hope I can involve you with the topic of human rights, due diligence, and tax compliance. So, I would like to start present our initiative, our voluntary initiative founded in 2021, the University of São Paulo Business and Human Rights Working Group. It's a working group that was conceived by our professor and supervisor, Professor Eduardo Sá Diniz, and my colleagues Daniela Prata and João Vitor Giannichini. We are a group of students who disaffected by the increase in human rights violations by companies here in Brazil, especially in the context of the pandemics. We seek to address through various webinars topics that involve the human rights and business agenda. So our purpose was to bring the topic to the discussion by inviting professionals, academics, professors, and friends to debate various aspects that deal with COVID and vaccination, biodiversity, and the Amazon rainforest, predictive criminal law, algorithms, conduct, big data, and AI. Also, the International Treaty on Business and Human Rights, the Lieferkettengesetz, the German supply chain law and productive chain laws, including the special participation of Professor Daniel Schanfelde, with whom we will also have the pleasure of learning. And all of our videos are available for free on YouTube in English and Spanish, because our intention is to bring the debate to the public and engage researchers, students, and stakeholders from Brazil and other countries in these joint opportunities for practical and academic collaboration. So if you are interested in the topic and in our agenda, it will be a pleasure to receive an email or contact you for future collaborations. So for this year of 2022, our intention is to publish an audiobook, gathering this material and also design specific events, probably in a different model from the workshops, and also trying to bring companies closer. So in order to really bring about effective changes in the business environment. So our purpose is to bring about changes that are effective and allow the corporate sector to be in the line with ESG and the human rights paradigm, ensuring its effectiveness. So here we are building our agenda this year, and it will also be a great pleasure to be able to count on your participation with suggestions. So we invite those who wish to get involved. Well, I was invited by Professor Daniel to speak on the subject of an article recently published by the publishing Tirand Leblanc. My article is about human rights, due diligence, and tax compliance towards a human rights benchmark in the corporate tax field. And the book has just been published, it's still in Portuguese, but we hope that soon in other languages such as Spanish and English. The idea of the work is to deal with the subject of tax compliance and tax injustice. So the book gathers several articles dealing with different aspects of tax compliance, addressing the relationship between compliance and artificial intelligence. Also, a very interesting article from a colleague from Angola talking about what is called as Luanda leaks. And for those interested in the fiscal aspects of compliance, I highly recommend the book. It's full of interesting articles from several colleagues and professionals that I admire. So entering the proposed themes I would like to start by bringing a more conceptual aspect of human rights due diligence. So, although the last few decades have shown some considerable progress in the awareness of companies about their responsibility towards human rights, the same cannot be said about the recognition of tax evasion and harmful tax competition practices as a fundamental aspect of corporate responsibility, and still less as a matter of human rights. So the notion of due diligence in the international context raised and gained prominence from the emblematic case of the Carrefour Channel, which is considered by the International Court of Justice, which was defined that is the obligation of every state not to only allow in its territory to be used for legal acts before the legal system of other states. So the development of the principle brought by this case led to the gradual establishment of due diligence obligations under public international law, involving matters such as environmental law, commercial law, terrorism, anti-corruption systems, and money laundering too. So in the tax area, however, before 2080, the financial crisis, there was no express notion of due diligence imposed on states regarding the obligation of their financial institutions not to harm other states, assisting in tax evasion practices, for example, and the absence of a normative provision in the tax field is not surprising if we consider, for example, that already in the 18th century, the rule of custom derived from a case of tea smuggling from England to France that prevailed. And also, we can say that human rights due diligence is a critical part of fulfilling the corporate responsibility to respect, is defined in the UN Guiding Principles on Business and Human Rights. So it's an ongoing cyclical process that takes account of the dynamic nature of human rights situations. So it is also a key tool in the global effort to build back better. So it enables companies to focus their attention on the most severe human rights risks and identify the human rights impact of their response to the COVID-19 pandemic. So a number of governments have recently introduced or have announced their intention to consider what we call as mandatory human rights due diligence regimes. So this momentum is building within Europe, this wide approach to mandatory human rights due diligence. So work has begun on a new legislative initiative, which would require companies to carry out human rights due diligence as some sort of legal duty or standard of care. So these mandatory human rights due diligence regimes have a potentially vital role to play as a part of a smart mix of measures to effectively foster business to respect for human rights, as we called in the UN Guiding Principles. So the new legislation, which is called the Mandatory Human Rights Due Diligence Directive, that was established in the European Union in 2021, is designed to impose new wide-ranging environmental, social, and corporate governance due diligence requirements on the whole value chain of companies established or operating in the European Union. So the new obligations can therefore apply to European and also non-European companies alike, and will affect non-European companies dealing with companies operating in the European Union. So companies whose activities fall under the scope of the new legislation are required to carry out some sort of comprehensive due diligence of their operations and indirect business relationships, upstream and downstream, in and outside of the European Union and publish a statement that they have identified no potential or actual risk to human rights and the environment or good governance, as well as the data and methodology used. So if risks have been identified, companies must publish, implement and report annually on their due diligence strategy and policies to monitor and also address those risks, including some kind of description of their value chain, and ensure that their business and business partners conform to that strategy. So sanctions for non-compliance are yet not are yet to be defined, but may include somehow proportionate but dissuasive administrative fines, financial and non-financial compensation, reinstatement, public apologies, restitution, and injunctions, as well as exclusion from public procurement, state aid, or even export credit agency facilities. So the idea behind this new legislation is that voluntary due diligence and national or sectoral legislation are actually not sufficient to combat these recurring issues such as child or forced labor, pollution, land grabbing, and corruption. So the new legislation is extraterritorial by design, by imposing like an European mandatory due diligence framework requiring companies to take responsibility for their supply chains. It intends to reach business practice everywhere in the world and promote a level playing field for all businesses in the European Union. So despite its wide scope, this new legislation has some limits. So it applies only to large companies, publicly listed small and medium enterprises with a business that is at high risk of human rights, environmental and governance issues, and companies providing financial services and products. So finally, it shall be a defense for companies to show that they have proper due diligence processes and effectively implement their policies to prevent harm. So the European Union endeavors to publish general non-binding guidelines to facilitate companies' compliance, and companies may be allowed to comply by collaborating through multi-party institutions. So this new legislation somehow gives extensive rights of consultation and accountability to third-party stakeholders. So the term is defined widely to include any persons or groups of persons whose rights or interests may be affected by the potential or actual adverse impact of the company, businesses, or business relations with human rights. So the intention is to engage and give rights of redress to stakeholders who might not otherwise have the means to do so under national or local law. So companies are also required to implement this non-judicial grievance and remedial mechanisms allowing stakeholders somehow to raise concerns about a potential or actual adverse impact on human rights. So the new legislation was introduced by the European Parliament in March 2021 in the form of a proposal directive to the European Commission. So when we observe the guiding principles also at all, there's actually an absence of the direct human rights impact on harmful tax practices. So working towards more harmonized approaches to human rights due diligence is potentially useful to reduce the potential for overlapping and inconsistent regulatory requirements, to somehow address the problem of gaps between regimes and to facilitate business compliance. However, there is not one single model for mandatory human rights due diligence regimes. On the contrary, when it comes to translating the ideas set out in the guiding principles into a legally binding one, there are many different variants, meaning that when people are discussing human rights due diligence regimes, they are potentially discussing a wide range of legal and regulatory possibilities. So for a productive and meaningful discussion of human rights due diligence regimes to take place, all the actors, policymakers, legislators, businesses, trade unions, civil society organizations, and other stakeholders need to be clear about the different design options available and the trade-offs between different choices, and be prepared to analyze each of these options carefully in the light of a specific underlying policy goals. So when we talk about the elements of human rights due diligence in developing mandatory human rights due diligence regimes, decisions need to be made out about the types of companies to which the human rights due diligence obligations will apply, the nature of the legal obligations which we will apply. So, for example, whether companies will be judged by standards of conduct, by standards of outcome, or both, whether liability will be automatic or based on proof or fault. So the scope of these obligations, for instance, the entities and activities to which the due diligence obligations extend, the subject matter coverage, for example, whether comprehensive or prioritizing specific sectors. So the human rights teams and risk target, for example, some may focus on a narrower range of issues and impacts such as child labor, modern slavery, or sourcing from conflict zones, and the way in which and the mechanism through which compliance with legal obligations are to be scrutinized and monitored and enforced. So the types of liability that will result from non-compliance, for example, civil or even criminal liability, and the sanctions that may be imposed, the remedial steps that may be required, and also the supporting regulatory architecture and services that may be needed. So, for example, guidance, consultation, regulatory effectivenesses, reviews, education. And in order to arrive at this kind of robust and effective regime that is implementable by business enterprises, we will need a widely consideration with affect stakeholders on the different design choices that may be available and the advantages and disadvantages from the standpoint of fostering business respect for human rights. So in order to ensure policy coherence with respect to human rights due diligence, policymakers and legislators will need a true understanding of the regulatory ecosystem in which the human rights due diligence regime sits. So policymakers and legislators should conduct a thorough review of surrounding legislation and policy initiatives in order to identify the amendments or adjustments that may be needed, transfer like a smooth and mutually reinforcing interface between this mandatory human rights due diligence regime and other legal regimes, that the new regime is capable of meeting its regulatory objectives, that the risks of any negative unintended consequences are identified and addressed, and that the regime is able to take full advantage of any opportunities that may be presented by regulation in other areas, for example, in the form of leverage or incentives to enhance this commercial or reputational drivers for carrying out human rights due diligence activities to a high level standard. So when we talk about aggressive tax planning, so it is important to consider that taxation comprises in general an important source of income for governments that helps to better distribute wealth in society. So due to economic and cultural factors, the composition of tax revenue differs from one country to another. So although corporations comprise only one of the several taxable taxpayers, according to data from the International Monetary Fund, corporate taxation represents about 16% of government revenues in underdeveloped countries, while in developed countries it's about it reaches like 80%. So at the same time that they have the greatest contributive taxation, and corporations are also those that make tax avoidance by large multinationals, which is a really iconic situation. So the drop in government revenue collection combined with growing public discontent with tax scandals involve these large corporations such as Amazon, Apple, Google, and Starbucks have somehow pressured states and international organizations to take an active stance in prevention, tax evasion, and other harmful tax practices. So the evolution of process and operational models for the production and distribution of goods and services, however, was not accompanied by rules of taxation for cross-border activities capable of adapting to the significant change in business practice and in recent decades. So the success of this layer of the market thus comes with this imperialistic logistic that make developing countries assume an increasing role in the world of economy. So in this kind of view of dependence. So exercising control over the most vulnerable states in order to extract resources and provide for their own economic interests is a plot that is also present in the word story of tax and collection system. So from a right-based perspective, more transparent and accountable interactions between states and businesses are at the roots of fairer and more prosperous society. So taxes assume a central role insofar as they incorporate elements of a social contract between the state and the citizens that enables the progressive fulfillment of human rights. So it's undeniable that tax collection assumes this kind of role in the flow of capital and consequently the reach of the extraterritoriality of norms and taxations. So undeniably, this is a scenario that favors situation of serious fiscal injustice. So in the view of the manipulation of the tax burden to the detriment of the jurisdictions in which wealth, in fact, is generated, leading to what we call as this market distortion. So although not always encompassed by this illegality, corporate practices have been to a large extent favored by an environment of international tax competition, which easily allows for corporations to elect the best jurisdictions for the company to offer its results through taxation. So the sophistication of corporate structures, however, has not been accompanied by this equal increase in the internal protection rules of national jurisdictions, which as a rule have taxation based on universal basis on transfer prices. And in this context, the asymmetry in national taxes combined with the effects of the harmful tax computation consolidate a situation of considerable drop in tax revenue collection. So For today's multinational corporations, so tax avoidance and the use of tax havens have become commonplace and even an integral part of modern business practice. So although these practices have recently garnered considerable media attention and public criticism worldwide, some corporate leaders have demonstrated remarkable non-challenge toward or even expressed pride in their tax avoidance practice. So for these corporate leaders, if national governments have not yet made it legal, it is not wrong, in fact, in the view of some, but if this attitude prevailed in areas of business, corporations would still engage in environmentally harmful activities, human rights abuses, and other forms of socially irresponsible activity for the sake of maximizing shareholder value. So, like other socially irresponsible activities, tax avoidance has the potential to harm a corporation, its shareholders, by damaging the corporation reputation, the corporate reputation, and inhibiting its branding efforts. So it also imposes costs on individuals outside the corporation that outweigh any potential benefits to the corporation. So when we try to explain the difference, it's clear that tax evasion typically refers to illegally reducing tax payments, while tax avoidance generally refers to legally reducing tax payments. So the distinction is primarily a legal one. Tax evasion refers to conduct involving some level of deception, concealment, or even destruction of records, whereas tax avoidance refers to behavior that the taxpayer hopes will serve to reduce his tax liability, but that is prepared to fully disclose. So if the distinction between tax avoidance and tax evasion is that the former and the legal, why should we somehow castigate multinational corporations for engaging in activities that by definition fall within legal limits? So tax avoidance, and particularly the use of tax havens, is not only financially detrimental to shareholders of certain types of corporations, but also harms the governments of the nations involved. So by treating tax avoidance as a corporate social responsibility issue, multinational corporations can eliminate these harms and attract consumers and investors, and at least is the idea that I would like to support here. So governments face enormous difficult taxing multinational corporations in a global market characterized by these cross-border activities and involving intangible assets and transfer accomplished by the push of a button. So, for example, the wholesale financial market involves trades of highly mobile incorporeal properties that give the sector a unique flexibility. So several of the methods that modern multinational corporations use to avoid taxes have a common denominator, the tax haven. The use of tax haven is a common way to evade taxes, and tax havens are naturally a common site for tax avoidance activities as well. And in fact, the vast majority of international tax avoidance involves tax havens. So there is no authoritative definition of what constitutes a tax haven. They are fairly described somehow like a financial conduits that in exchange for a fee use in their one principal asset, which is sovereignty, to serve this non-resident constituency of accountants and lawyers, bankers and financiers who bring a demand for the privileges that tax havens can supply. So in this context, how can the corporate social responsibility actually help? So multinational corporations avoid and evade taxes in tax havens primarily through transfer pricing. So according to the Organization for Economic Cooperation and Development, a transfer price is a price adopted for bookkeeping purpose, which is used to value transactions between affiliate enterprises integrated under the same management at artificially high or low levels in order to effect an unspecified income payment or capital transfer between those enterprises. So when we consider transfer prices, does not always involve the use of tax havens and this legitimate practice as long as the corporation abides from this arm's length principle, which requires multinational corporations with subsidiaries in more than one country to value transactions. So since tax avoidance is legal and is morally acceptable, or perhaps even the right thing for multinational corporations to do. So what motivates a corporation to use tax havens or engage in tax avoidance scams in general? So several studies indicate that corporate tax avoidance strategies, which is referred to tax planning, are often pitched to companies as a way to increase financial accounting earnings, thus boosting the firm reputation, possibly share price. But when we talk specifically how the corporate social responsibility doctrine can actually help, one might argue that corporations taking advantage of tax havens are merely maximizing shareholder wealth and should not be responsible for moral behavior that exceeds the legal requirements. So critics of the corporate social responsibility doctrine have similarly argued that corporations leaders should not be saddled with duties beyond profit maximization. So despite this opposition, advocates of environmental sustainability and human rights have successfully used corporate social responsibility to convince corporations to make social responsibility in these areas of tax. So CSR can provide a conceptual framework and a practical vehicle for multinational corporations to adopt anti-avoidance practices. So though there are many definitions of corporate social responsibility, I would suggest that corporate social responsibility provides a useful framework for evaluating corporate practices that do not necessarily align with the goal of profit maximization. So for this reason, discussions of CSR in an international context often involve the consideration of social, environmental, and sustainability issues. So in the era of globalization, corporate social responsibility has become much more prominent. So corporations seeking to minimize costs have strong incentives and opportunities also to seek out for legal environments that less stringent regulate, for example, human rights and environmental abuse. So self-regulation affords multinational corporations the opportunity to shape the CSR initiatives to balance public expectations with corporate needs in the line with the policies underlying the business judgment rule. But why actually is tax avoidance a corporate social responsibility issue? So tax avoidance has rarely been discussed in the context of corporate social responsibility. There is, however, some indication that tax avoidance, and as distinguished from tax evasion, is perceived as a morally reprehensible business practice. So one potential explanation for the lack of attention to tax avoidance with regard to CSR may be the taxation lax, that sensationalist, attention-grabbing nature of environmental and human rights abuses. So the media's continued devotion of attention and resources to criticizing The tax practices of Apple, Google, Amazon, and Starbucks, however, may suggest that tax avoidance is indeed becoming a sexy topic. So such negative publicity may cause reputational harm to multinational corporations that engage in tax avoidance practices, which in turn may cause financial harm to their shareholders. So corporations that adopt anti-avoidance practices as part of their CSR frameworks, however, could avoid such detrimental effects while potentially boosting investments and sales. So some CSR proponents also insist that engaging in socially responsible activities is not only the right thing to do, but also it produces long-term financial gains in excess of any short-term gain from engaging in socially irresponsible activities. So how actually tax avoidance harms corporations and their shareholders is a very interesting question. There are, in my view, basically two main harms that can be evaluated as a consequence of tax avoidance by the corporations. The first one is this harm to corporate reputation. So many companies already facing this intense scrutiny for their tax avoidance practices. So some analysts say that the pressure not to push avoidance too far is mounting, and companies may have more to fear from the public than from the government. So consumers' perceptions of corporate performance are more sensitive to the news of socially responsible activity than to news of socially responsible activity. So a corporate tax avoidance becomes increasingly publicized and stigmatized. News of a corporation engagement, however, in tax avoidance practice, likely will have an increasingly detrimental effect on its reputations. So such mild consequences can be explained by the fact that the corporations had little to lose from such a reputational hit to begin with, and the corporations therefore likely decide that the benefits of adopting a tax avoidance strategy outweigh the cost. So conversely, companies whose success depends strongly on their reputations are more likely to avoid the tax compliance scheme in favor of tax practices that are less likely to attract public scrutiny. And the second main harm to this corporate socially irresponsibly conduct is the harm to national governments. So as multinational corporations use of tax havens is yet another way of tax avoidance practices, it can cause harm to third parties. So tax havens have been charged with this undermining the international financial regulatory environment and taxation policies of these countries while the allocation of costs and benefits of globalization. So this choice to relocate in order to avoid regulations is specifically easy for corporations that transact in goods such as finance and technology. But I think there are solutions for incorporating the anti-avoidance doctrine into corporate policy and changing corporate tax avoidance culture. So multinational corporation directors and officers inclined to adopt anti-avoidance policies and practices face usually two main obstacles. The first one is the loss of competitive positioning in the marketplace and the opposition by shareholders and investors, because paying more taxes conflicts with the idea of maximizing shareholder wealth. Corporations that adopt these anti-avoidance policies will encounter many of the same barriers as the corporation that practice traditional corporate social responsibility policies. So how did corporations come to embrace the CSR doctrine despite this real or perceived conflict with shareholder objectives. So Professor Felix Martin suggests that three principal means of selling the message of CSR have been consumer activism, investor influence, and voluntary measures taken by leading corporations. So anti-avoidance proponents can use the same tactics to overcome the barriers through competitiveness and investor approval. That application of the CSR doctrine to tax avoidance policies may cause. So all of the three are actually conceived by the professor as these consequences of adopting the CSR doctrine combined with these shareholder objectives. So here with the conclusions, I think that it's important to reflect that for many years, multinational corporations' use of tax havens and other tax avoidance practices have frustrated tax collection agencies, governments in both the developed and developing worlds, and shareholders. So despite numerous anti-avoidance efforts by national governments, NGOs, and other international organizations, corporations and tax advisors have managed consistently to maneuver around new regulations and discover new loopholes to exploit. So although name and shame strategies provide this proactive, deterrence-oriented approach to combating tax avoidance that many governments have found appealing, these strategies have achieved only limited success. So academics rarely have discussed tax avoidance in the context of the CSR. So anti-avoidance practices match many of the characteristics that embody other socially responsible activities. And as the financial harms that tax avoidance causes exceed the financial benefits to corporations, so the corporations at all should recognize the social responsibility of tax avoidance practices and approach tax paying as another component of their CSR doctrine. Also, the link between corporate governance and the impact of fiscal practices on human rights has long been neglected. So in a review of the literature on agency theory, corporate governance and taxation, it's evident how national tax systems can mitigate or amplify global governance problems. So the reverse can also happen. The nature of the corporate governance environment within large transnational corporations also can influence the nature and the consequences of the tax system. So in parallel with international initiatives, the debate on tax evasion and tax justice has even more involved human rights, breaking this approach traditionally focused on civil and political rights. So harmful corporate tax practices thus became high on the international political agenda. In a scenario of growing capital mobility, and in this view also from the spread of production, the supply chains of large corporate actors around the world, this kind of redesign of national fiscal frameworks represents just one of the initiatives necessary to enable efficient fiscal compliance. So the exchange of information is a crucial aspect, and there is no fair competition nor transparency without the exchange of information. So the international commitment assumed by the G20 for the purpose of improving revenue management and more efficient tax collection seek to improve practices of disclosure and transparency in the region and destination of revenue, especially with regard to large multinational corporations. So overcoming equally visible reluctance to accept corporate social responsibility practices. Due diligence practices in this context can be improved as it seeks to respond how corporations can, through the due diligence, show that their tax practices do not inflict human rights in no way. So the harmful tax practices from the perspective of human rights allows reaffirming that their substantive force and enabling a direct connection with legal practices that, however, provoke severe human rights abuses, and at the same time, the measurement and the quantification of the cost of tax compliance invariably include in its scope these proposals for simplification and integration of legislation and national tax systems. So the gap in research and understanding of these costs for the corporate sector needs to be explored in order to help the states make more sound decisions about reforms in their respective fiscal but also tax policies. So I think it's finished. Thank you all. I'll be truly happy to receive your comments and also your critiques about the presentation. Thank you so much.